Good afternoon, traders. What's going on? I am an associated member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA/SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure, it almost doesn't look like it, but there's been a lot of turnover in my position disclosure since the end of last week. Because I had gotten out of SMH short, I'd gotten out of TQQQ short. I went long NVIDIA, I went long Meta, I went long Microsoft, I went long Oracle. I'm out of all those longs now, and I got into smaller shorts that are probably going to be a little shorter duration, but I did keep a little bit overnight with TQQQ, NVIDIA, and SMH. So kind of back in those names, but much smaller and only at some pretty good prices for today. Alrighty, let's have a look at the market. SPYs here up 1.6%. Wow. Q's 2.25%. IWM up a full percentage point. So the Russell was definitely what was relatively weak throughout the day today. The Russell almost worked its way to a gap fill at a certain point, but it held it and bounced off it. Dollar flat green. Gold up 2.7%. Oil up. Bitcoin. You know, crypto bounced, but I was saying before in the virtual trading forum in the close, I don't think it's up enough. I don't think that given how big the index bounce was, I didn't think that non-profitable tech traded well today, generally speaking, and I didn't think crypto was up enough. 1.25% in Bitcoin at this point is kind of not a lot. Ethereum 2.25%. Not great. Solana, 1.5%. That is nothing to write home about. So, crypto doesn't really seem to be confirming the risk-on mode of this rally at this point. So we shall see. Obviously, a little bit of a, I don't want to call it a gap and go, but gap and eventually a close higher on the combination of the news that the government's probably going to be reopening, which created a little bit of a VIX crush as we expected. So VIX came down. This really started Friday afternoon, right? Friday afternoon, we started to see the rumors that a deal is probably going to get done this weekend. So you saw the market catch a bid. You saw the VIX begin to front run that, roll back down. And then we continued that today. Market gapped up, VIX gapped down, and the VIX pretty much closed on lows. So like we spoke about a bunch of times in the last couple weeks, whether or not the market went down on the government shutdown is not the point. The point is, more importantly, the VIX went up. So the fact that the bounced all the way back. The fact that the VIX went up because people were putting on more hedges or whatever means that when you get through an event, you have a higher capacity for the market to break up, which is exactly what happened here. Interestingly enough, we closed above 680 in the SPYs as well today. So a close above 680 is really where I was saying it's kind of a technical line in the sand, or above 680, the market technicals start to look really bullish again. It'll be interesting to see how we trade tomorrow. I want to make sure that we can hold that 680 through tomorrow, just because I'm expecting, we had 2 days in a row of a massive expected vol control bid, like 40 billion in a flat market, I think, on Friday, and like another 20 or 25 billion in a flat market today. I don't remember the exact numbers, but they were huge. And that was because we were rolling off October 10th and October 13th from the realized vol set on the 1 month look back. But now we should be through that. So we won't have as big of a bid from vol control the next couple of days. But maybe that was all we needed, right? Maybe that was all we needed to not really trigger the CTA selling again, even though we barely did trigger those levels on on Friday, and for the market to get saved. And even if vol control is not the continued buyer after Friday through today, maybe somebody else takes the baton, like we've seen happen so many times since the April low. Maybe it's retail, the corporate buyback bid. It's so difficult to be short into this November, December period, and it's looking like that low on Friday was the low. Again, I really wanted to see a little bit more of a positioning washout than we actually got, and I saw some more data from retail. Retail did not get washed out basically at all last week. They were huge buyers, in fact, last week. Maybe in a few certain cohorts, like the non-profitable tech and crypto area, they might have gotten washed a little bit. But from a market-wide perspective, retail was not only washed out, they were big buyers again last week, it looks like. And you still have never unwound these systematics. I mean, you unwound vol control a little bit because of October, but CTA is still sitting at like the 99th percentile. So I really wanted to see a little bit more actually of a roll off from the systematics to come in and buy this market more aggressively. But the move on Friday was enough for me to really greatly reduce my shorts, which is awesome because I was just able to be so flexible on my trading today, which felt really good. So I don't really have a lot else to talk about. You know, it was kind of, if we just go back to the small time frame in the market and discuss how it played out. Whenever we have these large gaps, I always want to see how the gap gets handled, right? That's the first thing that I'm always looking for. The gap creates extension, and you know, how does the market handle the extension from the gap? Does it correct it through time? Does it correct it through price? Sometimes you see an opening squeeze that might last for 10, 20, maybe even sometimes as long as 30 minutes before you get a pivot high, and then you get the time price correction. That's the first thing I'm always looking to measure. But generally speaking, I like to fade large gaps unless it's a specific type of a gap called a breakaway gap, which this was not. I like to fade large gaps for smaller time frame trades to then see what happens. And then once you've got like a really established pivot low and pivot high, those kind of become your go-to price points to pay attention to see who's truly in control of this market for today. Where do we get the continuation from? So we had a really large gap up, and we squeezed higher for the first 10, 12 minutes or so. I think that was more of a positioning squeeze than anything. People who were chasing back into this market, or maybe some shorts who didn't cover well enough on Friday getting squeezed out because the gap was so big. But then we very impressively time digested for an hour. We went sideways for an hour. The ADMA on the 5-minute fully caught up. It really felt like we had some equilibrium between sellers because the gap is so big, you know, profit takers who maybe bought on Friday versus buyers who were, you know, being forced back in either because they're a short that's getting squeezed or a long that's underinvested as the government is set to reopen. And that really created a strong equilibrium for the first hour or so. And then we kind of broke and rolled down. I remember as a team, we were really watching this 678, which I think Tate first communicated and called out. Just the support level intraday that was being established. We lost it. We rolled down a little bit. And we had a 15-minute time frame price correction. It's funny, when you get the really large gaps like this, remember time frames, right? So the first 45 minutes to like hour of the day, like through, and anywhere through like the 10:15 to maybe as late as 10:45 a.m., the 5 minutes really what's in control and really what you want to pay attention to. But somewhere around that 10:30 period is when the 15-minute becomes significantly more important. So when you get this big of a gap and you time correct the 5-minute, and it takes a full hour to time correct, and then it's 10:30 and you've just gone sideways, you're looking at this ADMA catching up and you're saying, wow, maybe this becomes the springboard that really snaps this market higher because this is a bull flag now at this point. And that is the correct technical thinking to have. Usually when you get a bull flag continuation, it happens when the ADMA catches up to price. However, it takes so long to correct that large of a gap through time that by the time it's corrected, it's 10:30, and what starts to really matter much more significantly at 10:30 is the 15-minute chart. So yeah, sure. Now my 5-minute chart says we can go, and looks like we even attempted to go here at 10:20. You saw that uptick on that green bar on like the first test of the 8 EMA on the 5. But the extension on the 15, because of that time of the day, was too great, and there just wasn't enough momentum to propel the market higher at that point. So we gave a little bit more of a 15-minute time frame correction. You can see that here on the 15-minute chart. Rolled down into that equilibrium zone, created a pivot low, and I actually feel when, different time frames, right? When I talk about usually the large gap and I want to see the opening high and opening low get established, and then I can see who's in control based on what breaks, usually I mean a 5-minute chart. But in today's case, the 15-minute chart really actually was what was more important, because we price corrected on the 15 eventually. So we get this low at 11:30 in 15-minute equilibrium. You've got your high, you've got your low. Market begins to bounce off of that. Are we going to create a lower high at 678 or less and then roll down to making a new low and work towards filling the gap and work towards more of a failure? Or are we going to break the opening high and get upside continuation? Well, today's answer was we broke the opening high. Bulls really showed at that point that they were in full control. Then they broke through 680, which is a key resistance level from a handful of trading sessions back, and closed us above it. So, by the end of the day today, the bulls really showed that they are the ones who are back in control of this market. You have technical confirmation on the daily chart. You have the vol control bid that came in today that helped move that higher. The market was up 1.5% today. So we've discussed in the past about ETF, levered ETF rebalancing and that impact on the stock market. We've seen in the past, Charlie McElligott at Nomura modeled $7 billion of buying per 1% up move in the market. Market was up 1.5% today. So, you've probably got 10 to $11 billion just based on that one model of a leveraged ETF buying that's coming in on top of everything else that just propelled this market higher. People know that. They're front running it, and we were able to close really strong. So, like I said, I'm just curious to see if we can hold it tomorrow. You show me that we hold above 680 again tomorrow, and I'm like, all right, now for sure we have the confirmation. I just want to confirm that, we definitely have the technical confirmation here above 680 in the SPYs. I just want to confirm that this wasn't just a pure flow of funds, vol control bid, intraday handing the baton to the front runners of the ETF, levered ETF rebalance flows that actually enabled us to close above that level. In other words, if it's just not there tomorrow and we lose it right away, maybe we're going to be in a little bit more of a range-bound type of market than a market that just immediately accelerates to the upside. But being more straightforward about things, based on today's close, it looks like these bulls are totally in control. And that's it. I'm seeing Liam's comment here out of the corner of my eye. We still want to pay attention to those proverbial canaries in the coal mine, right? Meta, which this is just satisfying some extension to the downside. Meta can easily bounce into the 640 to 660 area. Oracle continued to be actually really weak today, and obviously the big one is going to be how NVIDIA trades. NVIDIA's earnings report that's coming up. The NVIDIA 197.50 to 200 area is the level that I was really looking at today to see if it holds some resistance, and it didn't seem to act as resistance at all. NVIDIA was incredibly strong. I think it closed up 6% on the day or so. Yeah, 6%. Impossible for the market to be down when NVIDIA is up 6% with the market cap weightings at this point. But, traded like butter through that resistance level into the afternoon session. Didn't close above 200 or even trade above 200, but that's a zone, and it traded really well in that zone. So, I guess that is the update for today. Happy to answer any questions. Yeah, the RGTI numbers they're really good. They're really good. RGTI, 1.9 million in revenue versus estimates of 2.17 million. Loss per share of 62 cents versus estimates of 4.5. That's pretty bad. That's so dumb. I'll read what Tate's posting after the afternoon meeting is over. Can't really read it right now. Unless you think it's important for me to read out loud. What else here do we got? From Tate, when it comes to anything post 12, it's mainly 30-60. That's the time frame where the 8 and 21 tend to matter. Yeah, once you get to the middle of the day. Yes, I agree with that. What do we mean by vol control bid? First of all, it's not volume, it's volatility. So typically when we say vol, we're referencing volatility, though every once in a while people say vol when they mean volume. We typically mean volatility. So what do we mean when we say volatility control bid, vol control bid? It is one of three main large systematic positioning cohorts that we pay attention to. So when you think about the market, take a big step back and kind of do a little review here. When you think about technical analysis, what is technical analysis? Well, my definition of technical analysis has always been quite simply the study of supply and demand in the marketplace. Now, most people immediately assume that means, charts, studying charts. And yes, a lot of technical analysis is studying supply and demand by studying charts in conjunction with volume, learning and knowing chart patterns and trends and things like that, right? So when you're looking at a bull flag, what is a bull flag? A bull flag is a pattern by which buyers drove a stock to a higher price. That's the flagpole. And then they run into an area of overhead supply, so some sellers, but the buyers are still there that drove it up to begin with, so they kind of meet equilibrium for a little while. You can almost look at what the SPY did today in the beginning of the day, even though it was with a gap instead of trading higher. So they're kind of at equilibrium for a while, and then when the buyers are able to deteriorate away the overhead supply, then you get another leg higher in that stock, right? So that's like the definition of the technical analysis portion of a bull flag. So when I think of technical analysis, I do think of what I just described with charting, but broadly what I think of when I think of supply and demand is the totality of the flow of funds in the marketplace. In other words, all of the buyers and all of the sellers in aggregate that move the market. That includes even people like you and me. Now, people like you and me, as much as I like to think I'm a pretty big trader, I'm not the one that's moving the stock market. My individual flow is not enough to really be creating significant market impact. Maybe a little bit of market impact once in a while, but not any significant, consistent market impact that's coming from really probably almost any one buyer or seller. That's not true. That's actually very not true when I think about things like Captain Condor. We can get into individual stocks and small caps and low floats and things like that, and that's a little bit different. I'm kind of more meaning market-wide for the moment. So when we think about the totality of all of the buyers and sellers, they can generally be broken down into certain cohorts, right? And many of those cohorts, they can be measured. So some can be measured more accurately than others. So for example, one really important cohort that is, in my opinion, particularly difficult to read, though not impossible, is retail. What is retail doing? How much buying or selling are they actually doing? You can't really fully know that number until after the fact, but you can, look at things like the call flow that's coming into the market and understand what percentage of that's coming from retail, and you can have a little bit of an understanding of how retail is applying their flow into the market. So retail, that's a cohort. Long only funds, long short funds, institutions, that's kind of another cohort. They're a little bit also, the non-systematic ones, a little bit also trickier to kind of model. But we know what their positioning is. We know how long or how short they generally are. So even if that's after the fact, and I don't know, just because they happen to be very long or very short right now does not necessarily mean that they have to be buyers or sellers next week or next month. But we can understand when, like in February, the institutions were long at the 97th percentile. That means that they don't really have much left to be able to buy. They don't necessarily have to become sellers, but they're probably not going to become buyers, and they could become sellers, right? So we can model that a little bit as well. So you got retail, you got institutions, you've got one of the most important ones is the corporate buyback. So the corporate buyback bid is massive, $1.25 trillion, I think, is the number that is expected from stocks to buy back their own stock over the course of the year 2025, which is a new record. The number one buyer in the stock market is corporations themselves. They are the biggest buyer in the stock market, and they have significant impact, and they don't buy uniformly because they can't buy around their earnings report. So you get periods of time where that flow is basically, actually what I was about to say isn't true. I was about to say that flow is never a seller. It's not true. But on a net basis, it doesn't seem like it's ever a seller. But there are periods of time when they are buying less because they're in a corporate buyback window, and periods of time when they're buying more, like in the month of November or the month of August, because they're outside of that window. So like right now, probably for the rest of this month, I'm expecting the corporations themselves to be buying like $7-8 billion worth of stock per day. It's a big number. And when we think about these numbers, right, like I just said, $7-8 billion worth of stock per day, I usually think about that in terms of $50 billion being a full day of all of the participants combined. In fact, it's probably a little bit bigger than that. It's probably like 50 to 100 billion. But that's the context that I'm usually thinking about it in. Like, okay, like, if we might get a total of $50 billion of flow of funds today, and I know that $8 billion of buying is coming from corporations, well, that's a very significant number, right? So that's how we want to think about those numbers. So corporate buyback bid is a huge one. You've got, some market structure flows that we pay attention to, like the gamma level of the market. So last I saw, gamma was like around 3 billion or so. That has an insulating effect when it's a positive number. If the market goes down 1%, you're going to run into $3 billion of buying. If the market goes up 1%, you're going to run into $3 billion worth of selling. Gamma can be negative sometimes, in which case, if you're down 1%, then you're going to get even more selling. If you're negative $3 billion gamma and you're down 1%, you're going to get an extra $3 billion of selling. If you're negative $3 billion of gamma and you're up 1%, you're going to get an extra $3 billion of buying. If it's a negative gamma number, it's additional flows in the direction of the movement. If it's positive, it's insulating, it's against the movement. And then the final big one that we pay attention to, which really is the direct answer to your question, is systematic funds. And the cool thing about the systematic funds is that they're big, they move the market, and they are probably the most easily modeled. So not only can we see what they've done yesterday and last week, we can see what they are expected to do based on various scenarios for tomorrow and next week and next month. So these are always going to be if-then statements, like the Goldman Sachs one that we post a lot. If the market, we just had it here in the VTF, I think, right before the market closed. Yeah, it was posted at 359. If the market is flat this week, so this is just from the CTA trend following systematic. So there's basically three main different types of systematic flows that we pay attention to. One is the trend following community. One is the volatility community. That's, again, what your question was, and I'll circle back to what that is in a second. And three is the risk parity community. They're a little bit smaller, but you can see here at 359, because we can model some of this, that the CTA trend following community, because of last week's price action and because they're so long already, in a flat tape this week, they're going to sell $1.5 billion out of the United States. In an up tape, they'll sell $1.7 billion. Remember, this is over the course of a week. So that 1.5 and 1.7 billion, think about it again in the context of 50 to 100 billion dollars per day. This is 1.5 or 1.7 over the course of a week. This number is a non-event. It's not going to have any market impact at all. If the market were to go down, you could get $15 billion of selling to the downside. That matters a little bit more, right? That turns into like $3 billion a day on average in a down tape. And obviously it wouldn't even be per day. It'd be probably more focused because, as it's moving down, it would hit harder. And over the course of a month, if the market were to trade down, you could get $75 billion worth of selling over the course of a month, right? So that's really cool that we can model that flow. So I know that no matter what, this week, the CTA trend following community is actually going to be either very small or potentially a little bit bigger selling in this market. And again, we can model that. So the question is, are there other flows out there that can overwhelm the selling that's coming from CTAs? Well, absolutely. We just said in Uptape it's $1.7 billion to buy over the course of a week, which is nothing, but you're getting $8 billion of buying per day from the corporate buyback bids. It's overwhelmed. Now, finally, another one of the cohorts of the systematic community that we pay attention to is what we call the volatility, the vol control bid or offer, I guess, if it's selling, right? What is vol control doing? What is that systematic fund doing? We knew that on Friday we were able to model this, and today they were expected to be very, very large buyers. Very, very large buyers. On Friday, they were set to buy like $40 billion worth of stock. It's a massive, massive number. Again, think about it in terms of, on a typical day, $50 to $100 billion is your total flow of funds. And I'm telling you, one cohort alone, vol control, is going to buy $40 billion today. It's massive. Can it get overwhelmed by the other flows if retail freaks out and panics and sells more than $40 billion worth of stock today? Yeah, it can happen. And Friday was such an interesting day because you had that massive vol control bid, but we were still able to be weak for the first half of the day. So for the first half of the day, any buying that might have been coming in from vol control, I think that they tend to do more of their buying in the afternoon, was overwhelmed by the fear and the panic of the market breaking down and the other sellers that were out there. And then, of course, eventually we bottomed out around noon. We closed down really small on the day, and there was a really strong systematic bid all afternoon. And then that continued into today's trading session. So that, the trend following community, the CTA trend following community, they derive how they buy and sell based on the trend, right? So, and that can also be be modeled, right? So we know per this note that got posted here in the VTF at 359 that the current short-term trigger level is 67.05 in the SPX. That's where you would begin to see, if we can get below 67.05, an increase in selling from CTAs because their trend model is breaking. Their uptrend model is breaking, so they're selling, they're stopping out. Well, the way that vol control toggles how much buying or selling they do is based on the realized volatility in the market. So, realized volatility, very simply put, the realized volatility number is just how much up or down the S&P closed on the day. So today, if we closed up 1.5% in the S&P, the realized volatility number from today is 1.5%. The way that these vol control funds work is that the smaller the realized volatility, the less volatility that is existing in the market. Like, you get a day where we're closing unchanged, that's being viewed as zero realized volatility. The less the volatility, the more exposure they want to have to the market. The closer that we close day in, day out to 0% to unchanged gain and loss, the more buying they're going to do. The wider the percentages are at the close, the more selling or less buying they will do. And they base this based on typically 1 month and 3 month look backs or averages. So like, what is the average volatility, roughly speaking, over the course of the last 1 month or 3 months? So when you think about the 1 month toggle, well, 1 month ago's trading session was April 13th. April 10th and April 13th, we had two very large realized volatility days. I don't remember the exact percentage of the down move on this day. Was it 3% on October 10th? It might have been a little bit less. I'm not sure. And then I do remember that this subsequent up day was like 1.6, 1.7, 1.8% to the upside. And coming into that, the vol control funds had been net like maximum long, because prior to that, every single day the market was closing up like 0.2%, 0.1%, 0.3%. These very, very small up days that we were having every day. So vol control kept buying and buying and buying and buying until they had nothing left to buy. And then you had a really large increase 1 month ago in volatility that caused them to sell because the realized volatility number went up. But now that is 1 month ago, it's rolling out of like that 1 month average. It's rolling out of the 1 month look back. So the selling that basically came in because of those days is now actually turning into buying a month later when that's gone. Though it's still in the 3 month window, 3 month look back, which is also something that gets taken into account, but it seems like the 1 month is going to be a little bit stronger. So the interesting thing about today is that we were set to have a really large vol control bid today, but the market closed up 1.6%, 1.5%. The bid was actually going to was probably much, much less today, believe it or not, than it would have been had the market been closer to unchanged from the vol control universe. To the point where at a certain point on the upside today, we probably lost the vol control bid entirely. But one of these other really important flows that I didn't mention, which is another newer-ish one, is from leveraged ETFs. So I was talking about it in the VTF a little bit earlier in the day. We had seen a model from Nomura like a week or so ago that said in a 1% up move right now, leveraged ETFs are forced to buy $7 billion worth of stock. So that's a $7 billion buy flow, right? Again, think about it in context. That's just on one day, and that's in a 1% up move. Today we were up 1.5%. So it should be $10.5 billion to buy from the ETF leveraged rebalancing community. So what I think happened today is you had good news, obviously, from the government shutdown that caused a gap up. But, we were up, we're rolling off such a large 1 month look back realized vol day that even in a 1% up move, we were supposed to get $13 billion worth of buying. So we opened up like 1% or so, and then we actually rolled down a little bit, so the percentage was even less than 1%, which means that the vol control bid gets even bigger. But once you get to like 1.5% today, that is about equal, by the way, to what we rolled off from a month ago. I think we finished up 1.8% or something like that on that day. So once we got to like 1.5% up today, you actually basically pretty much lost the entirety of the vol control bid because you're kind of keeping that same amount of realized volatility from that exact same trading session a month ago. But I think at that point, the bid was able to be sustained because you're also on top of that now getting this bid from the leveraged ETF forced buying that comes in, or what Charlie Miguel likes to call synthetic negative gamma, that further continued to buoy us higher. And that's why I want to see tomorrow. I really want to see tomorrow if we can hold 680 or not. If we hold 680 again tomorrow, that's how I feel really confident that the bulls are fully in control and that this wasn't just like a, one-off strength coming from a one-off bid from vol control that then ran into the leveraged ETF rebalance. So I hope that more than answers your question there, Mustafa. And if you have any follow-ups on that, I will be happy to help out. Rocket Labs is popping. BBAI is popping. Warren Buffett will no longer write Berkshire annual reports. You hate to see it. You hate to see it. From Greg, Friday really felt like programmatic selling at the VWAP and the small time frame EMAs in indices like NVIDIA, for example. Brant kept pointing it out. Then it felt like it turned off and the vol control buying overwhelmed the lack of any other sellers. Yeah, that, you know, we described Friday morning in the morning meeting as, is this going to be a battle of flows? Because we're actually finally triggering a CTA sell trigger, but we're expected to have $40 billion worth of buying. Man, it's just so crazy how markets work. Because it's like you really kind of need everything to come together. You know, like that October 10th day was big realized vol day that triggered all that vol control selling. I think I saw a note that we've seen like $180 billion over the course of the last 1 month of vol control selling. But the retail bid and what the VIX did and everything was able to save us from triggering the CTAs. So you didn't get both at the same time. And then on Friday, when we were finally ready to trigger the CTAs, we were fighting a vol control bid because it was exactly 1 month after that large realized vol event. So, you know, from what I've seen, and Greg, you made a comment earlier in the VTF. I don't remember exactly what it was, and I said something about it earlier. I don't know if you were listening or not, but you made a comment about how, like, you know, they never make it easy. And first thing I want to say is I disagree if that's exactly what you said. I might be mistreating your words here because it was earlier in the day. But I disagree. I don't think that they never make it easy. I think that they rarely make it easy. But once in a while they do. And from my experience, when they do is when you can get all of these flows to kind of be triggering at the same time. And that's been the thing that this market has lacked here over the course of this last month, is that we can't get all of it to trigger at the same time. You know, the October down move triggered vol control, didn't trigger CTAs. The November down move finally got to the point where it's triggering CTAs, but because of the October move, you're getting the vol buying that's coming in that's saving it. You're not getting it all at once. In February of this year, we had it all at once. And that was with every community. You know, we keep talking about, like, you know, we spend a lot of time talking about the systematics because I think that they're great because you can model them so easily and it's such really good information. But we have spent some time, but maybe not enough, talking about how, like, that Goldman Sachs positioning indicator has been more or less negative for a long time now, where we got one quick week where it ticked into positive, or otherwise I think it'd be setting a record for how negative it would be. So if you go back to, like, February, you had, like, the long short funds long at the 97th percentile, in addition to CTAs 100% long, vol control 100% long. Like, you, every once in a while, it's rare, but you get everything that kind of lines up where you are in an environment where there is no one left to buy or there's no one left to sell. And that's how I would describe where we were on February of 2025. And then on top of that, we got a catalyst, and the catalyst was Trump with the tariffs. Another example that I remember very fondly because of how well I nailed it was November 2023 was a situation that was the complete opposite. It was a situation where all of these models that we look at right as we got to the very end of October, so you can see here on my chart, October 27th, 2023 is the low. On that day, the market's at $10 a downside extension. So start with that technically. We're at $10 a downside extension, 3 large down days in a row. We actually closed weak that day, but I had just gotten back from a vacation. I was screaming from the rafters based on what I was seeing. Everybody needs to buy. And I did have the benefit of fresh eyes because I had just been gone for a couple weeks, and other traders were probably battling this October down move, and I come back fresh from vacation, and I'm like, okay, so we're in one of these situations where it was almost like the opposite of February this year. Everyone's about to be forced to buy. We were looking at the vol control, the CTA. Everybody's a buyer in every situation, 100% to the upside. Plus, it's about to be November, so you're going to get the buyback bid that comes in. It was like every single thing lined up, and that just made for this incredible move into the end of the year. So, I was able to just go back, like 2-3 years and come up with two instances of everything lining up perfectly. So I think that like easy setup where every flow lines up perfectly and gives you that like macro A+ situation is rare, but it does actually happen, and when it happens, it can be extremely profitable to take advantage of. Makes sense. I was referring to the 7 to 10% pull large for retail to load up for Santa rally into the year end with seasonality flows. I don't think the market was going to make that so easy. Yeah, I wish. And of course, this bid, a hammer candle with confirmation, means some missed it. Yeah, I mean, me too, Greg. I definitely did not get as long as I would like to have, or as aggressively as I would like to have on Friday. I think I've said it 3 times today. Like, I'm happy enough because of how well I managed my shorts into that down move. Like, I really liquidated a lot of short exposure that I caught for most of this move. It made for a really good P&L week for me. And then I, got out of, I don't know, like 3/4 or so or more I'm out of by Friday's low, probably more than that, of what my total short exposure was. And then, even was doing a little bit of buying, but I definitely was not aggressive enough on the buying. It was just, like I said, I really wanted to see more of a positioning wash than we were able to get, but it circles back to this entire conversation of just not getting the perfect setup. I didn't get a further positioning wash because vol control came in and saved it because it had to buy so big that day. You just couldn't get all of the pieces of the puzzle to kind of hit at the same time. And it just is, it is what it is, So not every pitch is a pitch that you want to swing for a home run because you don't perfectly have all of those flows lined up. And we didn't quite get to that point this time around either. But there will be more opportunities. Now I actually, more than anything, even though I don't really have the long exposure that I would like, I hope that this market just goes. They never really triggered the CTAs. Let's let vol control buy their exposure all the way back. Let's the interesting thing is just how weak sentiment still is, market sentiment, when you look at those numbers and like the fund flows like we were talking about. Let them buy back in a little bit. It's not a coincidence that the one time that Goldman Sachs positioning indicator flip positive is basically the top of the market, right? Let them start buying again. Let them flip that positive again. Let vol control buy back in, and then when we get through this year and we get through the corporate buyback and we get to mid-January where those flows can change a little bit, let's have everybody in the pool right as we see, a flare-up of fears related to this AI story, or, at some point we'll be approaching midterms. It's still pretty far away. But, some of those bigger flare-ups that might be able to present themselves from a catalyst perspective when we can get the positioning lined up that actually maybe can give us that pitch that we're looking for. And until then, we'll grind it out, right? We'll grind it out on both sides of the market. I think I missed something from Tate. If you don't mind, I would love to hear your thoughts on the second Burry tweet. Second Burry tweet? I see. Oh, is that Cassandra Unchanged? Is that? Oh, that's Michael Burry. Okay, yeah. Understating depreciation by extending useful life of assets artificially boosts earnings. One of the more common frauds of the modern era. Understating depreciation by extending useful life of assets artificially boosts earnings. I understand what he's saying, but I have no experience in that depth of fundamental framework for companies with how depreciation works to give any feedback on the first sentence. Let me read the second sentence. Massively ramping capex through purchase of NVIDIA chip servers on a 2 to 3 year product cycle should not result in the extension of useful lives of compute equipment. Okay? Massively ramping capex, 2 to 3 year product cycle. Okay? If this is exactly what all the hyperscalers have done, by my estimates, they will understate depreciation by 176 billion between 2026 and 2028. By 2028, Oracle will overstate earnings by 26.9%, Meta by 20.8%, etc. But it gets worse. More detail coming November 25th. Why do I gotta wait that long, Mr. Berry? Stay tuned. I don't have a lot of feedback for you on that one, Tate. It gets honestly a little bit outside of my expertise. I'm not a deep fundamental balance sheet guy to be able to answer the specifics on how that aspect of the balance sheet is formulated to add up to earnings. So we got to do our research, I guess. But what Michael Burry seems to be describing, my takeaway from it is that what Michael Burry seems to be describing is how the circular financing of AI that we've all been discussing implodes. And we know that obviously he's probably talking his book a little bit with his NVIDIA and Palantir puts. But that seems to be the general message of the statement is the circular financing cannot last, and this is the actual method. Like everyone keeps talking about the circular financing, obviously myself included. But I am incapable of really, really being able to tell you, like, in depth what's wrong with that. Like, obviously I get it, right? Like, they buy the NVIDIA chips, so therefore NVIDIA is worth more, so therefore they can take that money and buy a stake in the company that bought it, et cetera, et cetera, et cetera. Like, I get the general commentary behind the circular financing, but this seems like it gets into a little bit more depth on how the circular financing has the numbers kind of cooked. The books are cooked. So those productions don't last over 3 years until they are outdated, 5 years until they don't perform well, life cycle, and the GPUs are small. Yeah. From Greg, I read an article about last week. I think the argument comes down to the useful lives of these GPUs. If they depreciate over 5 years and take smaller depreciating expense over the short term, earnings are overstated. Then they turn around and replace the assets in 2 years, presumably without taking the older assets out of service. Yeah. So there's that, and then isn't there? I don't know if this impacts it or not, but I think that Trump is trying to change the accounting of certain things where things can be depreciated like all at once. So I don't know what the impact is on that, or if there is an impact on that as well. But yeah, certainly something to note. So appreciate the post and the info. Over on the YouTube from Cyril, is a 2 to 3% pullback still max we can get to the downside? The Friday reversal with higher low was great in the SPYs. Do you think unless the VIX starts going up, we continue to grind up? Yeah, I kind of think we continue to grind up unless we see that the VIX gets back above 20 pretty quickly. I really want to see what happens tomorrow. But yeah, I mean, we got a 2 to 3% pullback on the market. It could have been more if we could have triggered those other flows. But we just went in depth on how all those flows work and how it just seems like you get potential selling from one cohort that runs into buying from the other. The battle of flows always wins on the bull side, and you need that to not be that way if you want to get more of a, you know, an actual correction. And this is where it also, I think, pays attention to, I like knowing the statistics of how often we get pullbacks in the market. And I think I read this somewhere even just today. I'm trying to, I don't recall, but like I like knowing. Oh man, and I think I just read it today, probably this morning, and I don't even remember what the numbers were. But it's like you get a 5% pullback every 3 to 4 months, a 10% pullback on average every 8 months, and a bear market, I think, once every year and a half on average, like a 20% pullback once every year and a half on average. I really like to think about those numbers when I'm thinking about how long it's been since we've had a pullback, what the current percentage is, and therefore, you know, what the probability is of that percentage getting deeper. Like, when you think about a 5% pullback that happens, you know, once every 3 to 4 months, is it more likely that when the market pulls back 5% that it's going to end up being down 10%? Or is it more likely, and this is everything else held equal, right? So this is just a general thought exercise. Or is it more likely that that 5% pullback leads to all-time highs? And the answer is it's more likely that the 5% pullback leads to all-time highs. If the market goes down 10%, is it more likely that that 10% pullback is going to lead to a 20% bear market? Or is it more likely that that 10% pullback is going to lead to new all-time highs? The answer is new all-time highs. But you can't just blindly buy a 10% pullback assuming that you're going to get all-time highs, because once in a while that 10% pullback does become a 20% pullback. So you really need everything to kind of converge. But I like to think about those when you get, you know, a pullback, and especially if you're as I've been many times, long, and you're long into the depths of that pullback, and now we're down 7%, and I'm asking myself, you know, like, how should I be game planning myself here? What should I be doing next? Like, are we going to get back to highs, or am I going to be in trouble because we're halfway to the bottom? I think it's a healthy exercise just to kind of know those percentages and think about it. And then when you can think about those percentages in conjunction with the flow of funds, then I think you start to have a strong edge on the probability of what's going to happen next. And when you look at the mixed flow of funds that we have here for November and the degree of bullishness of some of those flow of funds, and you think about, all right, if we were able to go down 5%, what's the probability that 5% becomes 10% or 5% becomes all-time highs? I would say you go from the normal answer of higher probability of 5% becoming all-time highs to significantly even larger probability of 5% becoming all-time highs, right? So that's where we are here in November. And that's where we are in this little pullback that we had, which was what, 3% in the SPYs, 5% in the Qs, 6% in the Qs, something like that. I wanted it to be a little bit more, but you know what they say about hoping and wishing and wanting, right? So I think that looks like that was it. Looks like that was it. Let's see how we trade tomorrow and if we hold 680. All right, awesome afternoon meeting. We dove into some really good stuff. Like always, it was because you guys brought great questions and comments to the table. So keep it up. Have a great night. I'll see you all tomorrow.